So this is going to be a good little scan, discussion just some equities in the future of the equity market and my idea going forward and what I kind of envision as far as the opportunities that I see, and the kind of short bias that I continue to have to some extent, um, but also just being pretty open with what's happening and how to spot the opportunities regardless long or short, although I do think that the over leveraging of long is very unoptimal up here. Um, but being able to spot some opportunities, commons wise, the options trading is there, but not so much really. This has been a environment that has really not been offering a ton of leverage exposure. I think there's a time and a place for options, leverage in general, but options being, trading against time and volatility is a very important thing, and there's a time and place for getting exposure with that. I don't know if there's such an edge here on a lot of names. There's some here and there, maybe on a longer term short-sighted perspective, but I haven't seen too many very aggressively slam the table options trades quite yet, right? So if we simply just look at SPY, I think the last video I did was like Thursday. Um, we we still don't really have anything appealing. I mean, you look at the week of the 28th of July and everything that follows, the diminishing volume, the daily structure being very, very unappealing, the highest volume coming in on the first, and following the earnings reports on Microsoft and Meta that gapped us up to new highs on both names respectively, and then the subsequent failures that we had after. And we have this, 3% reversal. We have this range building out, and then it all enters into that kind of August 4th window of strength, event charm flows for the equity market, right? And so when you have such a decline happen so quickly, yes, it's a very good sign for the short-sighted environment and having that perspective. But you also have to understand a lot of people are going to get short on this breakdown, and a lot of people are going to get trapped into a window where the movement under the hood holds a lot of relevance to the performance of the equity market in general. All right, so we get this leg up into post August expiration. We see a nice decline, and then we see the pop on Jackson Hole. And the thing about this Jackson Hole pop is there really wasn't much volume backing this. I mean, if you just go ahead and look at the volume on this hourly print, there's really not a strong bid here. It's just more or less kind of the pop, the fade of the highs. And then we have two inside bars on a candle like this. Um, really giving you like a failed breakout is a bad look as well. When you see a 1.5% move followed by a subsequent consolidation and then failed breakout, I mean, you can just see very clearly the exhaustion from a specific side at these highs, right? It's very, very notable, and there's a lot of things that are telling, but the market can stay irrational longer than you can stay solvent. And that's really been the case here because we've been developing a distributed range since May, since that 3% decline we got in May, post May OPEX. But the structure hasn't shifted, the character hasn't changed. It's been more or less waiting. And I will say the longer that this waits and the closer we get to quarter four, um, and just those end of year re-leveraging effects and then the relevance behind the January and December expirations, the more unoptimal the short-sided trade gets until late quarter one, 2026, right? Just because of the timing things, overall. So I will say, although we are building out a range, this could happen. I mean, you look at how it happened in quarter four of last year in February. This took a while, right? We saw the massive reversal in August. We saw the continuation, and then we saw the range build out. The footprints, Fed meeting in December OPEC or of expiration, the three lower accumulation into the election gap stalling, the deep seek, the footprints were there, the edge was there, but you have to understand that this took, I mean, we saw preliminary signs of distribution following the election, and we didn't really get a leg until 3 months later. So this could take a little bit of time. I do think that this happens. I do think that there's a lot of red flags. I think at minimum we decline to 564 early next year. But at maximum we decline to under these lows that we put in April. But it's just a waiting game. It's a patience game. the volume backing this Jackson Hole pop is weak. The structure that we've developed is unappealing. The failed breakout and the higher highs, I mean, this is your initial high on the 3rd, your secondary high on the 31st, the 3rd, and now the progression is just continuing to stall. It's very notable. We still have one more week of weakness, and there's a lot of red flags that I'll discuss. The semiconductor space looking really bad, the consumer staples space and energy space looking relatively good, that give you these red flags for the risk on names. But it's a waiting game, it's a patience game, and I've always said, identify an opportunity, execute accordingly. If you have a short side position up here that you've been building out since July that you're looking to pay you into September, that's probably not a good idea. But if you're building out a short here, understanding that this could take a couple months, a couple quarters to build out that short exposure, I think that's a good trade because I think that the signs are there. I think that even when you look at QQQ, this is our potential lower high. We've seen the rally, the leg off the earnings reports, the exhaustion, a little bit more of an extensive leg into expiration in August, and then the continuation off Jackson Hole. Once again, not a truly strong bid, and the 3 inside bars that give you this failed breakout on Thursday, and more volume on the Friday sell-off than we had on the Jackson Hole pop. And that's very telling to me. That's very, very telling. And this weekly print is abysmal, right? You look at the leg on the week of the 28th, the exhaustion, the hanging man candle, and then the lower high potentially being put in. I mean, that's not a good look. And this is a big time spot at 575 where we had that previous seller. And when we broke above those highs, saw that subsequent exhaustion put in above that and a very clean, this 4% leg stem from the failure above these highs. And so going into this week, QQQ is 100% a short side focus for a shorter term trade because when we have this rally and it's coming off of the initial attempt on this 559 analog, chances are with how weak this is and how, notable this lower high could be, you could take a pretty clean risk to reward trade targeting 554. However, it's speculative. The week is short. I do think that something can happen. We have jolts, jobless, NFP, I think, if I'm not mistaken. But there's not a good look here. And if you say that there is, then you're fucking delusional. I mean, it's simple as that. If you say that this looks very good and appealing along, then you're fucking retarded. There's not a good look up here. Even just failing a pivotal spot at 575 is very big. And understanding, how this leg happens, right? Just being able to pay attention to a lot of names as well. You look at the semiconductor space. I've talked about this path of least resistance. Jesus, look at the volume on this candle on Friday. And I've talked about the potential for this to be a path of least resistance through the highs where this is all, we break out above the July 2024 highs at 283 and just the exhaustion is notable. And you see, 3 higher highs, a potential lower high within a bear gap here on the Jackson Hole pop, weak volume, no true structurally sound bid there. And then the exhaustion that stems after. If you just look at this, I mean, this is just so notable the way that this tape behaves. And I was just reading the tape the entirety of last week. There was no structural sound bid. This is very gross. This is an insane amount of volume to be put in on this candle, especially in comparison to the day that we had last Friday on the 22nd. Big time things happening at big time spots. And 283 is the line in the sand for me. And that is a pivotal point in the semiconductor space, where you have some of the leading names in the entire equity market building out distributed ranges with gaps to fill below. TSM, we rally into the report. The report gives you a very ugly look. We continue to see no signs of a true bid. We fill some gaps. We continue to pop and get exhaustive looks. And then we put in this very weak rally once again on another attempt off of the February or January highs. And where does the volume come in at? How does it come in at, right? And it's just these things all lining up and giving you this very unappealing look on not only daily but weekly charts. I mean, even monthly charts, right? I'm not a fan, and my short-sighted thesis is still there. You have the Marvell report that kind of started it off. This name has been getting obliterated lately on these earnings reports, 19%, 18.6% on some very notable volume. But things don't look good, right? AVGO, I don't like this name either. We have a report coming up this week, so that'll probably hold some relevance. If there's a semiconductor that I do like, it's Intel, but this has been an underperformer not only since August, since April, but since 2022, right? Like this is a completely different name in a different point within the chart in a different time perspective of the long-sighted focus. If the tape doesn't flip, if we don't get the short, I think that this is going to be a phenomenal long. I think this is a great long on Common's focus as a long-term portfolio holding. But if the tape doesn't flip, I think this offers a good long opportunity. Somewhere off this 26.43 spot to 29 would probably be my best bet on like some October exposure. Even like MU, this is not giving you the best look. Neither is LRCX. We had these accumulations built out since August of last year, and the capitulation that we saw in April and the rally, it's now kind of exhausting itself. And then NVIDIA, the biggest one. The most important name in the entire equity market is NVIDIA, right? The largest company in the world. And we have put in a 2% red week on 1.37 billion volume where we've had a range being built out for a couple months. And it's just not a good look, and it hasn't been a good look. And yes, I was very early being short up here at 142, but there were signs, in my opinion, and there were also signs to not get super aggressive short in June, but that was my fault. But we rally, we see legs. Where does the volume come in at? How does this high act, right? And we just exhaust on the earnings report. Where even look at November, these earnings reports generate so much liquidity and counterparty fills on a double beat on NVIDIA above the 183 spot where we've seen a seller be very dominant, predominantly active in that range. And we've just been building out a range since July. It's notable. I don't justify having a position on this. Absolutely not right now. What I do justify is getting a good gauge for the broader equity market in the risk-on space by looking at NVIDIA and looking at the rally we have from 87 to 180 and the way that this tape has been feeling, not only since mid-July, but since May, since late May, since the May earnings report. I still think this gets obliterated. It could happen this year. It could not. It's really up for grabs. It depends on how soon the tape flips. But another name, AMD, right? We put in that hanging man, ugly print off of the report. We see the kind of continued distribution being put in August, the nice leg. And what do you notice, right? You notice the failure to really take out these important lows where there's been a predominant buyer off of this earnings report that sparked a leg and then another high sold off of this leg that we put in into expiration. We haven't taken those out. And so when I see the higher highs being sold off on very aggressive volume, and the legs be aggressive as well, but no signs of an accumulation being there, happening in a pivotal spot after an aggressive rally, I'm pretty bearish on this chart. I don't really justify taking a short exposure quite yet on here. I do think that this 173 to 176 window could be very, very appropriate to take some October positioning, targeting 158 and then targeting potentially 140s. I think that's probably a really good look going forward, but I wouldn't justify it unless we see that kind of gap and golden pocket be reclaimed, and then the progression gap from the earnings report. A lot of confluence and conviction behind this little $3.35 window. But other than that, I would really wait. I do think that the 146 target can be met. It all depends on if the tape flips, though. But 283 is big. I think anything under there can really set off the semiconductor space, and in turn can really set off the equity market in terms of the risk-on names. We have financials. I told you before, right? This is going to take a while. We've now seen 3 highs be put in above the previous all-time highs that we established on March 3rd. And continued exhaustion is notable, but I have no edge here yet. When financials go, I'll execute accordingly. There's some names that I do like short side on financials, Schwab being one of them, but I have no edge quite yet. A name that is phenomenal long and can honestly outperform not only this year, but in the next year, is the energy sector. XOM predominantly being my main focus, commons and options wise. But I've been very keen on this consolidation that we've been putting in on the energy space, and look at the reversion that we have, right? Look at the 7% reversal, smooth like butter, absolutely insanely smooth, defending the progression gap, taking out the lows, seeing the climax is built out, and targeting the gap above that we have at 94, where we've been relatively underperforming in comparison to where the S&P 500 is um, relative to its April gaps, the tariff gaps. So this is big. I really do like XOM still, mostly because we had a gap in a discounted range being defended, and then we revert into this 119 spot. This is a good options trade if you want to take some September exposure. You don't really have to, I mean, you can have a pretty appropriate risk set for about $1 on mid-September's to October's, targeting at least like 110 to 113. Um, and then just ride out the commons as well, right? You're up 8.5% on commons. You probably get a good couple 100% on some options exposure, and then see if we get a nice little path of least resistance through this 115.45 spot where we've had two subsequent tests at the lower confines of this gap from April 3rd that haven't really resulted in much continuation from those sellers. So this is a top watch going forward. Always has been. CVX still looks pretty good. I mean, on a higher time frame perspective, this looks phenomenal. If you really want to take a gander at that. But we're reverting into the gaps. Oxy looks really consolidated, and Oxy is a really good telling sign, in my opinion, of the potential outperformance for the energy sector going forward. The 800% rally from COVID lows and the 2022 highs, and then the digestion, and then we have this potential higher low put in COVID, or not in COVID, in April. So I'm watching a lot of these on a longer term perspective. I mean, some long term comments on Oxy is not a bad idea, but I'm thinking more shorter term now, reversion into gaps, and then reevaluate. It's kind of where my edge lies, I think, in the energy sector. But there's definitely some edge going forward on oil, right? On energy. Um, there's definitely some kind of edge there, but I don't really think too far ahead in the future. We even look at the MAGS ETF, MAG 7 ETF. This looks phenomenal. Short side, phenomenal short side, disgusting long side. When you see, like I said, the legs stemming from exhaustion at the highs and the really weak bids and the failed breakout, but nothing quite there yet, right? And then we look at XLP. I think this might have got a little ahead of itself. I do think that this still outperforms, but I really wouldn't mind the May lows being taken out and like a discounted higher low being defended here, just because of the fact that we get the really clean breakout and then the breakdown following that. If we can take out this low, change some hands, and defend that discounted range, and then we see like PEP kind of consolidate after the 20% rally we had, like this will be a really good name to look at, a really good sector in general. This is very underperforming and very consolidated as well. Multiple months, right? Ever since April, we've been sitting in this kind of 3-point window. So this will be a focus of mine. XLK very similar to MAGS and QQQ. I don't like this at all. And ARKK as well. I mean, this is looking a little bit better, right? When you look at IWM as well, these ETFs don't look terrible. The small caps very consolidated, very constructive. I don't really like them too much, but like this little inside pat, like 4-day, 5-day inside bars, doesn't actually look terrible on ARKK. I think Tesla is a really good long on commons and potentially going forward on some options. It really depends on how the tape feels. If the tape flips or not, then I do have some good longs going forward personally. Tesla's one of them. I like commons here. Options not so much, right? But we just have a very compressed and consolidated range here with climaxes built out, but no clear kind of character change quite yet. I mean, maybe right here, 332 is a big spot. The June 4th closure and the earnings report progression gap from July is something that I'd pay attention to. But for now, it's just a commons focus. Meta 741 is big. This is not a good looking chart on a lot of time frames, but I don't have an edge on like any of these quite yet. I still do think that Apple can put in some kind of like lower high here, but there's nothing on a lot of these. There's no edge on a lot of these long or short. There's a lot of them have completed their reversion and are building out these distributive ranges, but have nothing really notable in terms of execution, right? Long or short, right? So, other than that, I mean, there's not much to say. This is a very bland market, right? We have the best long as energy. The best long was UNH, right? You have the long-term positioning you can take down here. You have the shorter-term positioning you can take down here. And you have the leverage positioning you can take down here, right? The leverage positioning, you have to cut that. The shorter-term positioning, I honestly, the thing is with this name right now is this could be our third low. This could only be our second. It genuinely depends. The longer-term positioning, I think you can push 380 as far as an initial target, and then maybe 480. So wouldn't mind not trimming any, leaving some more room to add. The shorter term positioning is where it kind of gets a little bit confusing here. Not confusing, but it's like you can take the shorter term ads, you can cover the shorter term ads, some of them, you can re-add here or re-add here. That would not be the worst idea. Options wise though, I would wait for a higher low. But this is a long focus going forward, still a phenomenal looking chart. But I'd want a little bit more consolidation to be established before I take any leverage exposure here. But commons are still beautiful, and honestly, the first trim I would even take on any commons would be 335 to 380 before even thinking about cutting any. Um, but I do like the sweep of this gap, but I want a little bit more of a consolidation, maybe progressive holding of this earnings candle. For move to 335. And then, if you cover some commons, you can say, okay, I'm going to re-add, I'm going to slam this, I'm going to set my risk appropriately and trim appropriately within this gap and then re-roll it as far as a shorter term position goes, and then take the options when it's offered. Because if we, fail this and then we break down, you can kind of stop out, rebid some commons on the shorter term, and then push that, right? Because, like I said, time frame, risk to reward, what is your perspective, like your what is your thesis and conviction on this chart? And if it's shorter term, I don't think you can necessarily justify not taking some exposure off after a 35% return on commons, and just appropriately either letting the rest of this rally make your position and then re-adding, or covering and taking some more ads on a higher low when you see fit, right? It just depends. I'm looking at that higher low, but I'm also looking at that potential for those lows to be taken out. Long term, I wouldn't trim any, but that's just me personally. SPY is a short focus, and so is QQQ. QQQ and AMD are more of short focuses going into this week, personally. And then PA&W. This is a phenomenal distribution, in my opinion, that we've been seeing built out since Q1 of 2024. Where does the volume come in at? How do the highs act? The lack of lower lows being taken out all lead me to believe that this chart reverts to sub $100 next year. I wouldn't take any exposure on this. This could be our lower high, our last point of supply, right? But for this positioning, with the earnings gap that we have, I'd more or less be inclined to let this play out, see if the tape flips, and if it does flip, we'll probably get a decline in the earnings gap, probably see a lower high, and then we can take some exposure short side to 170 to potentially 165. That would be more of my focus, so kind of a side watch going forward for me personally. PEP looks pretty nice right now. The anomaly on the weekly chart, putting in very high volume, small spread hammer candle, outweighing the last 2 weeks volume pattern, 3 volume, and just a pretty nice like capitulation, collection of inventory, changing the hands, whatever you want to call it, underneath the peg, and then the exhaustion, and then the rally, and then the stall, and then we have this potential higher low being put in at a reclaim of the earnings candle high and the golden pocket right now. For me, I would wait to take options on this. Probably wouldn't even have any commons on this. The commons trade was phenomenal down here. You get a nice leg, can cover another report, can cover even more, and then potentially add some more off of this kind of sweep of the gap. But we never really see a clean options trade here, in my opinion. So I'll be waiting on that. I do think that as far as a target goes, 160 is probably going to be my target for this. 156 to 160. Just depends. But I do like this name still. Palantir, I mean, this could put in a lower high, right? There's very predominant signs of distribution being established here on Palantir. But I have no edge here at all quite yet. Although this 25% reversal from peak to trough following the earnings report is very reminiscent of the 25% reversal we got in February off of that earnings report exhaustion. It's only a matter of time, I think, before this really starts to revert, but the tape needs to flip. That's really it for me. The tape needs to flip. Lift, constructive, small cap, not surprised. Um, Commons trade, really. Commons trade here, and you can take some exposure off and maybe target $20. We have constructive higher highs and higher lows in the daily perspective. A nice weekly look. The weekly candle doesn't look the greatest, but you look at the weekly chart or daily chart, this doesn't look bad at all. Defending that golden pocket, I would assume, yeah. It doesn't look bad at all. This is definitely like a commons focus on a beaten down small cap that can run. And it's one of those things, like I said, like there's long opportunities still, but you have to be cautious with them. Like longing commons on lift, catching a nice 40% or 32% rally, covering the majority of your exposure and making the rest of it either make your position or stop out is phenomenal. Same with UNH and then the longer term perspective. Same with XOM. Same with Tesla. But when the tape flips, the tape can flip aggressively. And so that's why you have to appropriately execute long. Yeah, I've been saying that for like 3 months, but you have to understand how this behaves and how these things happen, in my opinion. JD, this is a good weekly accumulation. I don't really fuck with the China names, but the really nice rally in September of 24, the attempt at a higher low met with a stall, and then those lows being taken out, and then we just see these daily climaxes and lower lows being put in. I mean, you can take a pretty objective risk to reward at a 14% bull gap at $30 and target 35 to 40 maybe. That's probably all I'd do. A longer term perspective, you could target 50, but I don't like these China names too much personally. So, I mean, yeah, that's pretty much it. It's really still a waiting game, right? We have one more week of Vanacharm flows not being present in the equity market. And then after that, it's kind of, we'll see. I mean, if we don't get a move by September expiration, then October comes in, we're in Q4. It's a little bit like, okay, I don't know if this is going to happen until next year, until mid to late Q1 of next year. But that's why I have long focuses in XOM, UNH, INTC, Tesla. PEP was a good one as well. And Lyft. These long focuses that you can take good exposure in commons, couple weeks of a position, cover and either stop out on the rest or maybe even re-add or even the rest just make your position. It just depends your exposure and what your risk to reward is and what your time frame is on these positions. But not a lot of options trades. I think maybe something could be setting up this week. We have some data. We have some clean looking potential lower highs on QQQ. So QQQ would be a big time focus of mine to 554 to 559. But there is very, very prevalent signs of a distributive sequence being built out on the equity market, specifically the risk on names, and I think it's only a matter of time. But the market can stay irrational longer than you can stay solvent. Although that weak Jackson Hole continuation is very, very notable. So good luck, have fun, be safe. Um, yeah.